The AI boom has been one of the most powerful forces driving the stock market in recent years. From explosive growth in chip makers to soaring valuations in tech giants, artificial intelligence has captured the imagination of investors worldwide. It has been positioned as the next industrial revolution, a once-in-a-generation opportunity to build wealth. But as we move deeper into 2026, a critical question is beginning to emerge. What if AI stocks are no longer the safe bet everyone thinks they are? At first glance, the optimism seems justified. Companies leading the AI race have delivered impressive earnings growth, strong revenue projections, and bold future visions. The demand for AI infrastructure, data centers, advanced chips, and cloud computing continues to surge. Investors have poured billions into these companies, believing they are buying into the future. And in many ways, they are. But markets don't just reward great stories. They reward realistic expectations, and that's where the risk begins to build. One of the biggest concerns right now is valuation. Many AI-related stocks are trading at extremely high price-to-earnings ratios, levels that historically have been difficult to sustain. When expectations are this high, even strong earnings may not be enough to justify the price. If growth slows even slightly, or if results come in just below expectations, these stocks can fall sharply. This is not because the companies are weak, but because the market has priced in near perfection. Another important factor is competition. The AI space is no longer dominated by a handful of companies. Today, almost every major tech firm is investing aggressively in artificial intelligence. Startups are entering the space at a rapid pace, and governments around the world are funding domestic AI development. This growing competition could compress profit margins over time. What looks like a clear leader today could face serious challenges tomorrow. There's also the issue of monetization. While AI has incredible potential, turning that potential into consistent, scalable profits is not always straightforward. Many companies are still in the early stages of figuring out how to fully monetize AI products. Some services are expensive to run, requiring massive computing power and energy consumption. If costs remain high while pricing pressure increases, profitability could come under strain. At the same time, macroeconomic conditions are starting to shift. Interest rates, inflation trends, and global economic uncertainty all play a role in how investors value growth stocks. AI companies, which are often valued based on future earnings, are particularly sensitive to these changes. When interest rates rise, future profits become less valuable in today's terms, and that can lead to lower stock prices.